Welcome to Aliasoft webinar. My name is Alejandro Delgado, Technical Director of Aliasoft, and thank you for joining us today in this webinar with the topic Energy Markets in the Recovery from the Economic Crisis 1 year later. Today, we have two speakers from Deloitte that are with us again after 1 year from our last webinar together, and that will talk about the financing of renewable energy projects and the importance of long-term price forecasting in audits and portfolio evaluation. Once again, the first speaker will be Oriol Saltó, Data Analysis and Modeling Director of Aliasoft, that will talk about the evolution of the European energy markets. Next, we go Carlos Milans, Partner of Financial Advisory at Deloitte, and then we talk Pablo Castillo, Senior Manager at Deloitte. If you have any questions at any time during the webinar, please use the Q&A menu, and we will answer them after the presentations. And now, I hope you enjoy the webinar. Oriol, please share your slides.
Thank you, Alejandro. Good morning, everybody. Happy to be here again in our monthly webinars after the break from the summer, and excited also because to be here with our Deloitte speakers, and also because of the times that we are living right now in the energy markets. Crazy moments with astronomical prices and a global energy crisis. So I'll go ahead and start with the presentation. I will go briefly about our company and the services that we are offering, and then we will go straight into the data and all the things that we want to show. So in Aliasoft, we are offering forecasting services for the energy sector, covering most of the European energy markets. Our forecasts go from the short term, so day ahead or hours ahead, up to long-term reports covering up to 30 years in the horizon. Obviously, we forecast demand and price for energy markets, but also any variable that is interesting for the energy sector. So renewable energy production, weather conditions, socioeconomic indices, fuel prices, CO2 prices, and not only day-ahead markets, but also intraday markets and ancillary services. The methodology that we used for forecasting is a methodology that we ourselves developed specifically for forecasting for the energy sector. The three main points that we always like to stress about our methodology is that it is completely scientifically based. So you get scientific results with that keep consistency over time. And what can we say more than we have been using it for more than 21 years right now, starting in the Iberian electricity markets and now covering all the European energy markets. So, as I mentioned, we are in a global energy crisis. We are recovering from the crisis during 2020 due to the pandemic of the coronavirus, and right now, while recovering the supply of gas, coal, and oil, it's getting a hard time trying to keep the demand. So we are in this crazy situation with very high prices, as we will see right now. Just starting with the Brent oil, I always like to start with this historical perspective of the Brent prices in order to see that we are already above the levels of the before the crisis in 2019. Right now, prices are in this last weeks, prices are start raising kind of little bit fast. Right now over the $80 per barrel. Some forecasts see this price around this level, around $80 by the end of the year. Other forecasts, other consultants put it more like in the level of $90 per barrel. So very high prices, because just with a recent historical perspective, the last time that we hit this $80 barrier was during also kind of a crisis. that we had in mid 2018. Looking the prices right now, these prices don't look like really serious prices, but at that time it was. So yes, high oil prices that are in this context of the global energy crisis. More dramatic is the prices of gas that we are seeing right now. Well, the data speaks by itself. Just in the last days, not really even weeks, we have seen increases of 20% plus 20%. So exponential growth day by day in the last days. Right now we are over 100 euros per megawatt hour in the European TTF gas. Prices that just a couple months ago, it was kind of difficult to believe that we could get to those really high prices. Right now, market is really struggling to get all the gas in Europe and all around the world, the gas that we need in order to face the winter, where reserves are low in Europe, are low in Asia also. So we are kind of struggling getting these reserves sufficiently high in order to be prepared in case the winter is it's a little bit colder than usual. So right now, market it's kind of in a crazy behavior, very volatile. Just this morning, it started by 6% up, then went 16% down. So very volatile, rapid increases in prices. So it's difficult to see where we are getting right now. The situation, as I said, as the winter, it's difficult to see if we will be ready for the winter. Probably we will still be in this kind of very uncertain situation during the winter. So the rest of the year and also the first quarter of 2022. In the spring, when gas demand usually lowers, it's probably the first time that we will be again kind of a more stable and predictable situation. But right now, it's difficult to say where is the ceiling for this price. It also depends a lot on what the main supplier of gas for Europe right now, it's Russia. So depending on what Russia says, if they say that they will be able to provide us with all the gas that we need, then so it's kind of a very volatile market right now. So difficult to see if there is a ceiling, but well, when we were at 60, we said, well, it's difficult to be at that level for so long. Right now, we are nearly twice that price, so it's difficult to see. But it's easy to see that these prices are not very. It's not possible to sustain these prices for too long. Similar situation with the CO2 emission rights in Europe right now. Around 60-65 euros per ton. Also a rapid increase. In this case, it's a more linear increase. So it's something that we have been seeing since the end of last year, and also CO2 prices pushing the power prices, the prices in the electricity markets to really high levels, as we will see right now. As always, I will not have to go through every market, but I'll show you our online platform where we can see some of the most interesting data right now. I think this one. Yes, here it is. So, for instance, these are the prices for the Spanish electricity market right now. Hourly prices over 300 euros per megawatt hour. Crazy values. Crazy values taking into account that just a couple months ago, the limit prices in the Iberian market was 180 euros. So just we removed that after removing this limit in order to put the limit at the level of the rest of the European markets. So, but after a few weeks after removing these price limits, we are already above them. So prices that were we could not think of them just a few weeks ago. So for instance, let me take okay, this is in a daily, and if we go back to the beginning of the year, we can see how dramatic has been the increase. So we go for January. So you see, just in January, we had the Filomena storm. We were feeling quite uneasy about this daily prices close to 100 euros. Right now, we are close to 300 euros per megawatt hour. Also, United Kingdom, it's having an even a more difficult situation. They're having peaks that are close to 3,000 pounds per megawatt hour. So really critical situation. Also, if we go back until January, you can see how in this last month, these last weeks, prices are increasing steadily, but kind of dramatically. What else you can see? Obviously, we can see what we have seen. We are having record prices all over the place. So this is the gas prices, TTF gas prices that we have just shown. You can see how the exponential growth that we are having in these last weeks. Also, let's see Brent price, CO2 prices, coal prices. I didn't show coal prices, but they are having a similar situation, also with important increases during the last month, and prices that were difficult to think about them just some months ago. And let me see. And okay, I will not have time to show all the markets, but here is just a quick comparison. We will see them a little bit more in detail afterwards, but you can see how the behavior is more or less the same in all the markets. Some markets a little bit more affected, others not so much, but affecting all the markets. Okay, going back to my slides, because if not, I will run out of time. So, okay. We also, this is just a quick reminder that we have also reports analyzing any aspect of the electricity markets for all the European markets. So this is, I put the reference here in the October last year. So one year. So 1 year from now, since now, sorry. So that was the last webinar that we made with the jointly with Deloitte. So this is the recovery of the electricity demand, scaled everything at the demand that we had in October last year. So basically here you can see how the crisis from the pandemic affected the demand in all the countries, and then you can see during the winter the different sensibility of each market to the cold temperatures, and in the summer the different sensitivity to warm and hot temperature. But basically we can see after the fluctuations during winter and during summer, basically we are more or less in all the markets at the same level, similar levels that we were 1 year ago. Very different situations with the electricity markets. So this is from January 2020. So the lowest prices that we get during the pandemic, April, May of 2020, and right now the exponential crisis that we are seeing. Right now that prices are so high, we have kind of 3 different levels of crisis. The central markets, France, Germany, and all the interconnected markets are the lowest prices that we have right now. Then we have markets, more peripheric markets, let's say Italy and Spain mainly, with little higher prices. And then we have the case of the United Kingdom with extreme extreme prices, that is where they are living the worst situation. This is a detail of the daily prices for the electricity market for the last days, where since the beginning of July, and you can see how in as we have just seen, how in UK they are having prices that were above £400, the daily average £400 per euro per megawatt hour. The rest of the countries having really important increases. So you can see how one day we are going close to even hourly negative prices in Germany just some days ago, and right now average prices above 300 euros. So very, very unstable, very uncertain situation that we are living right now. Let's take a look at what the futures market is saying, what the market agents are seeing right now about the future. So what are the prices that they are willing to pay now for the energy or the fuel that they will be getting in the future? And here I will be comparing the forward curve that we had 1 year ago, so in October 2020, from the one that we are having right now. Obviously, in the short term, we are always following the spot price. So right now, very high future prices at the short term, but then at the long term, they kind of converge. But it is interesting to see how 1 year ago we were below that long-term price, so the forward curve was going upwards. Right now we are above this long-term price, so prices are the forward curve is going down, and it's interesting to see how the difference in this long-term stable price from just in 1 year. So we are thinking here close to 2030. So in 10 years, the price 10 years ahead has been changing close to $10 per barrel. So it's it's kind of crazy to think about that. I think in 30 years, people are seeing a very different situation right now. So this just makes sense viewing in the strange and uncertain situation that we are right now. Even a more crazy situation we are seeing with gas. Right now, in the short term, we are close to 120 euros per megawatt hour. And at the long term, 1 year ago, we were around 15 euros per megawatt. Right now, around 20 euros per megawatt hour. So the long-term price has increased by 5 euros megawatt hour. And a little different is the case of the CO2 prices, where there is not a long-term price. The forward curve just follows the spot prices. So right now, obviously, with these very high prices that we're having right now, this is the level that you are getting in the futures prices. And the forward curve for the electricity markets, also very different situation that we were seeing 1 year ago. So if you look 1 year ago, forward curve they look just like flat. They were not flat, but with this scale, you can just basically see the level that we were getting. So again, at the long term, for most of the markets, we are seeing an increase in the futures prices at the very long term. But in the case of Spain, where we are seeing that basically the level, it's very similar at the long term that we were seeing. This is the reflection of the different situation that the agents are seeing right now in the Spanish electricity markets, where there is a lot of planned increase in the renewable energy capacity, and this is making an impact on the prices that the agents are willing to pay right now, even though it's impossible to buy or sell any energy for 2030 or 2031. The liquidity in this market is basically in Cal 22 and a little bit in Cal 23. So from there you just have synthetic prices, just having an idea what's the idea of the agents for the prices right now. And well, just I'll be ending just in time. Just trying to summarize everything, I had a really hard time trying to fill this slide. I could be writing for and filling it with data, or I could just leave it blank because it's kind of difficult to understand what we are seeing right now. Just keep the idea: gas prices, CO2 prices, everything is uncertain unless until the spring. So, and as a consequence, electricity markets are also very uncertain. So when we are making our forecast, we have our probability distributions, and they are getting really, really wide because it's difficult to see. It's obviously looks kind of more probable that prices that keep growing a little bit, but there's also probability of prices going down because as we are getting more in a more critical situation, the probability of a new crisis that will somehow or reduce the demand in some way. So it's really it's really uncertain. So it's difficult to put any conclusions because probably, well, the European countries are talking in the European Commission how we can face this problem, what we can do, because it makes sense for them to do something because it's affecting directly the consumers, large consumers, but also domestic consumers. So probably they will have to do something. How it will affect the short term, or it's more looking at the long-term stability, it's difficult to say. So, well, I cannot say much about the current situation. Just a reminder that at the long term, even we are seeing a very uncertain situation right now, at the long term, the trend and the level of the prices is not much affected with the current situation. So at the long term, we are seeing kind of a stability of what we were seeing before this crisis, before the pandemic. So at the long term, things are being consistent, let's say. And just let me finish inviting you to our next webinar. It will be the 11th of November, and in this case, we will have invited speakers from ENGIE. It will be in November, so we will be again in the middle of this crisis, and from there we will see what are the perspective into the future. So thank you, Alejandro.
Thank you very much, Oriol. And if the time allows us, we can continue to discuss this uncertainty in the Q&A section.
Yeah, sure.
You already have a couple of questions, I believe. Carlos, thank you again for joining us. And when you're ready, please, you can share your slides.
Yep. Well, thank you very much. Let me just present one sec. One second. Let me see. Can you see my screen now?
Yes, we can see the presentation.
I will put off my camera so you can concentrate on the topics. Okay. Let me just switch that off. Okay, so show must go on. After the comments from how volatile and uncertain are the electricity prices, what it is true is that we need to put our focus on the long term if we want to achieve all the objectives and ambitious objectives set up at European and world levels in terms of renewables. So before jumping into the details, I will just briefly introduce the services that we as a firm can offer. Many people, and I joined the firm only 3 years ago, but many people just believe that Deloitte and the Big Fours are auditing firms, right? As of today, at least Deloitte, which is the largest one of the 4 Big Fours, is only 15% auditing and the rest is consulting. So this is why in this slide you can see all the services that we can provide around renewables on the whole entire life cycle of a project, right? Since helping our clients in permitting and licensing, engineering development through the capital projects team, certainly helping with complex accounting advisory, which is the core of our business only a few years ago. We can certainly help financing, structuring financing and PPAs around renewables. Certainly, we can also help with financial information and reporting, which is key, as Pablo will comment on the second part of our presentation. We can certainly help monitoring construction from, again, capital projects team. We can help with audit and assurance services. We can also produce some monitoring service during operation, and we can also help you out in disposing of an asset, whether that's an M&A or refinancing or going public, right? If in case of a large portfolio, right? So just bear in mind that 85% consulting, 15% accounting, so we can deliver all through the value chain of the renewable life asset. Then my part talks about vision of investment and financing needs. I've been financing renewables for over 25 years, and a few years ago, starting also structuring PPAs. We did structure the first and large bankable PPA in Spain, so we know how to do that, right? Now, if you want to zoom out a little bit, I always say that the energy transition is unstoppable, right? So we came from feed-in tariff to market prices. Grid parity in Spain is now a reality. It will be also a reality in other markets. So I think that the Spanish case will be, and the lessons learned here can be exported to other jurisdictions if and when grid parity is reached, okay? And energy transition, as everyone knows, enables decarbonization, right? On the policy side, we have set up very ambitious targets. In the Spanish case, 50 gigas of additional renewable power in the period 2030, okay? That represents over 35 to 40 billion euros of investment, right? That is a huge amount of money. So how do we do it, right? The thing is that the uncertainty is there. So any transition brings uncertainty, as we have seen. This pool price of Spain is a little bit updated because it was only produced 3 or 4 years ago, as you can see on the prices that Oriol has commented, right? In any case, as we have seen here on the projections, on mid prices, the futures market just discounts normalized levels in the short term, and on the long run, we can see that there is a market equilibrium price, right, which will be around 40, 45, 35. It will depend, but I think those ups and downs can certainly be manageable in terms of financing, okay, and in terms of expectations of which returns can be expected when investing in renewables, right? So all this volatility is a consequence of very point-in-time situations like gas price, CO2, etc., and geopolitical, but certainly in the long run, which is what we were aiming at, it should stabilize. So how do we do it, right? Which are the required ingredients for success in implementing those very ambitious targets, right? So we have 3 main ingredients, like in any recipe, okay? Good renewable resource, we have it, okay? We have technology, we have human capital. Do not forget that we in Spain have companies that have been developing renewables since the late 90s, and up to a certain point, we're the first or the second country with the largest installed capacity fleet in renewables, right? We need good policies. There we can comment a little bit and probably on a separate session, but planning, legal security, network investment, manageability, storage, taxation, etc., are good ingredients also to provide stability and long-term stability and certainty for investors, whether those are national or international investors, just to keep putting money in those assets. Remember that those assets are still expensive to build, okay, although we have come down dramatically in PV and to a lesser extent also in wind with increased efficiencies, but it's still a good chunk of money that needs to be put in place for building 1 megawatt of renewable, right? So we need a very long time horizon just to recover our money and to get profitability. That is why I always insist in having a long-term vision, okay? And then the third ingredient, of course, we need a lot of money. We need debt and equity alike, okay? And both capital providers, as I want to call them, they need reasonable long-term return on investments and cash flow stability or unpredictability, okay? So we will focus on that when we will talk about financing on renewables, okay? So with the no need for feed-in tariff, so the feed-in tariff disappears. Volume risk, so production is a risk that is accepted. By price risk is not so much, okay? Why? And especially these days with a strong volatility and uncertainty, we need to tackle that risk, whether we are an investor or a debt provider, okay? So this is a major disruption for shareholders as lenders, because under the feed-in tariff mechanism, this risk was not on the table. So we need to tackle that risk, and this is why, to face this new scenario, it is essential to have a long-term view and a vision on electricity prices and other commodity prices that affect electricity, as we have seen gas and CO2, at least where the thermal gap is present in the Spanish market, okay? Financing and merchant risk, okay? There is an easy part, and which is CapEx, OpEx, tax assumptions are commonly shared by different shareholders and lenders, okay? So subject obviously to independent third-party valuation and review, we can conclude that is particular circumstances of a specific project, CapEx, OpEx, and tax assumptions are common in most of the projects, right? In terms of financing conditions, with the exception of minor difference, tenor of the debt and cost of that debt in the financing do not differ much between different lenders, okay? Certainly we can see some lenders benefiting or trying to be more inclined to do mini-perms, so short-term financings with a refinancing risk, but given the fact that the assets are long-term, many banks can now lend construction plus 16 or 18 years, okay? And Euribor plus 250, I would say, is a reasonable assumption for assuming the cost of that third-party debt, okay? Obviously, one difference between lenders and sponsors is that sponsors use the P50 production estimates for their equity return, whereas lenders use the P90 production for their sizing purposes, okay? So this is a classic, and I'm not going to spend a lot of time on this, right? Lenders, by definition, are more conservative. Typically they will put more money on the project, okay, if financial leverage is above 50%. So, you know, they want to have certainty that their money will be recovered first, okay? The not so easy part for financing and merchant risk is that pool price assumed by lenders for debt sizing purposes and by shareholders for equity returns are different, right? There is a significant mismatch between what the sponsors are expecting or they compute and introduce in the long-term forecast to calculate expected profitability as opposed to the long-term pool prices that lenders forecast and input in their financial models to calculate debt quantum, okay? This situation, okay, makes essential the implementation of risk mitigants for price risk, okay, for long-term price risk, okay? So this is why it is essential if you want to finance this on a long-term basis, or you are an equity investor that are a little bit more averse than others in terms of merchant risk, you will need to implement somehow and contract a PPA, so you can have a floor for your equity returns and less volatility around it. And if you are a lender and you want to lend on a long-term basis to a project, except a few banks that we will see later, they prefer projects that will have at least some part of the merchant risk mitigated, especially in the first years of the project, where debt amounts are larger and uncertainty is also larger, okay? Financing merchant risk, current situation is that for 100% merchant deals, there are only a few banks that are active and that can accept pure merchant risk, okay? Little market depth, so because there are only a few lenders that can do full merchant, the size of the projects that you could fully fund on a merchant basis will be between 100 and 150. We certainly have seen some projects of a larger scale to be financed in the market on a full merchant basis. We did, I remember, one wind deal of around 300 megas, but in this particular case, the purpose of the sponsor was not to maximize leverage, but just to, you know, they were convinced that the PPA prices that they were getting were not very good and they will destroy value for the shareholders, so they decided just to go merchant, right? In general, for pure merchant deals, lenders try to use very conservative debt sizing assumptions, okay? Whereas on a PPA plus merchant scenario, where we have hybrid deals, where you have initial years covered by PPA and a good percentage of their production, you have more active banks and greater market depth. Okay, you will have access to multilateral institutions, including, for instance, EIB in the case of Europe. Although there is a limitation still on maximum volume that can be covered by a single PPA. Okay, whereas in the financing we have seen in the past, and it's very common to have several lenders around a single financing and under a club deal or underwriting, and then inviting more lenders to come. In the PPA market, we haven't seen yet, although we'll be glad to explore the first case here. We haven't seen a project where there are more than one off-taker at a time in a project. Okay, if it's already complex to have the discussion between the three parties, sponsor, lender, and PPA off-taker, imagine having a multi PPA parties around a single project. We haven't seen this, and because of this, under a single PPA, we are struggling to get volumes for projects larger than 300 to 400 megawatts. Okay, so take that into consideration. You have a very large portfolio that want to finance under a PPA and merchant scheme, that you probably will need to split it into clusters of around 300-400 megawatt maximum each. Okay, and again, this obviously depends on market conditions. The PPA market today is a buyer's market, so the PPA off takers have the bargaining power on their side, and prices are very erratic. Obviously, the more volatility and uncertainty around pool prices, the more erratic and different will be those PPA quotes and conditions that off-takers will offer, okay, for financing. Before jumping into analysis of profitability, obviously we cannot leave aside the turmoil that the introduction of Royal Decree Law 1721 that has been recently published is provoking in the market. Basically, for those of you that are not aware of this, basically this Royal Decree aims at, while gas prices are above 20 euros per megawatt hour, okay, those generation plants that do not emit CO2 will be subject to an adjustment in the revenues, okay. So they will, because they will still under very high prices of gas, pool price should be still high where there is a thermal gap in the market, which is the situation today. We have seen gas prices above 100, as Oriol was mentioning, and pool prices way above 200 in the last two days, right? So where this situation prevails, the regulator thinks that those renewable projects, non-emitting renewable projects, are benefiting from the marginal price system, okay? And in order to ease a little bit the amount of money that those renewables will be getting, and therefore translating that into final power prices for the end consumers, they will be implementing an adjustment. Obviously, at GAT prices of 20, the adjustment is 0. But for instance, at GAT prices of 75, which is more or less the average of the last 15 days of September, and if CCGTs are matching or setting the marginal price in 70 or 75% of the cases, which I guess it will be the situation today. And not only CCGTs, here the regulation also mentions the other technologies that set up prices, taking into account the marginal cost of gas. We're talking about hydro, right? That also beats at the pool price at very high prices, just knowing that the thermal gap is there and the CCGTs are needed to cover the last megawatt of demand. This adjustment is now around 67 euros per megawatt hour. So this is a good reduction. Obviously, someone may say that if prices are 200 and you are deducting 60 or 70 euros, you're still getting a lot of money, especially as opposed to the projections that you certainly were doing as a sponsor or even as a lender, right? Certainly here, the more damnified parties are the integrated stakeholders that have generation and commercializers, and for those, this adjustment will be made on the entire production, as opposed to if you have signed a PPA with a third party, that PPA energy will be exempt from this analysis. Just a point in, just a small comment, because I know that most of you will be concerned about this, because it's creating some uncertainties about, whether the Spanish system is stable for long-term investment. I suggest that it is just there's very specific circumstances today around gas prices and CO2, but certainly it will disappear at the end of March, which is the validity of this royal decree. Okay, happy to take questions then on this. So going back to how we finance those assets and the PPA market overview, we can see that there are swap and floor structures. Okay, different implications. Obviously, in a swap structure, you have worse equity IRR, but obviously better for leverage, more simple and to structure, better accounting treatment. Probably Pablo can talk about that. I think the important part here is the prices we're observing today. Okay, for a 10-year swap on a base load basis, we're seeing 34, 37, and for a pay as produced, we're seeing 27, 29. Okay, this certainly will destroy value for the project. Okay, in floor prices, which obviously leave the upside to the project, whether you are a sponsor or lender, net floors on a base load basis, we're seeing 10 years at around 30. And we're seeing pay as produced floors at around 25 to 27. Okay, that is gross floor. So then you will need to subtract the premium, so the cost of the floor, because ultimately you're just buying an insurance, right? And then I think a few structures that we're implementing right now consist on swap and floor. Swap on the initial years, just because you have more certainty around the leverage that you can get. For instance, we can certainly get 40 euros capture prices for 3 years. And net flows of around 20, okay, net, which is net of the premium, right? PPA tenors, if you want it for them to be bankable, will need to be in the region of 10 years. 10 to 15 years are less abundant in the market, and certainly PPA tenors of between 1 to 5 years just are used to cover positions, but certainly not bankable at all. Okay. Then we're going to calculate some sensitivities around equity IRR depending on pool prices, okay, and yield productions. But for that, we have assumed here a typical PV project, 30-year average life, 2,000 hours per year, degradation, capex around 600,000, development fees on top of it, because I know that many investors are buying projects at different stages of development. So this does not reflect probably the full ready to build price, but something in the midway between starting a development and a project that has already land and grid connection. Okay, the rest of it is more or less a standard, right? In debt assumptions, certainly banks use the P90 for a PV project will be around 93% of the P50. Pool prices will use the lowest scenarios of different market advisors. Okay, debt tenors will have a recommended between 18 and 16 years. Targeted debt service cover ratio, important for many of you, 120 for contracted cash flows, 160 for merchant cash flows, and then maximum leverage. There is no longer 90% leverage or 95 as we used to do 15, 20 years ago. So take into account that maximum leverage will be in the regions of 75 for deals with a PPA and 65% without a PPA. Okay. So we jump into the next slide. So this is interesting. This is a full merchant deal with debt. Okay, after tax, you will see that on shaded in green are those IRRs above 8%. So if you have pool prices of around 40, you still have quite a pretty decent IRR. Okay, certainly is lower than 2 digits. Those 2 digits are no longer available unless there is consistently very high prices in the pool. So a typical project will have 2,000 hours per year. So you still have decent profitabilities with prices around 40 and above. Okay, 35 euros still okay, but certainly 35 euros per megawatt hour on nominal capture prices, I think is still a pretty low assumption for the long run, especially taking into account that during the initial years you have more weighting on the prices on your IRR, and certainly next year's prices are not going to be at 35, are going to be probably at 40, 45, and even 50, right? These figures around in the bottom of the page talk about the amount of debt per megawatt that you can get and the translation into leverage of those financings, right? We'll go fast to the next slides. We'll try to compare a full merchant deal, okay, to a deal with a 10-year swap, okay? let me just go to the next slide. You will see here, but on a 10-year swap, on the prices that we're getting today, profitability is destroyed. Okay, for the same 40 euros per megawatt hour on the market and 2,000 hours, you get only 5%. Okay, certainly we'll see before that was around 7 or between 7 and 9. Okay. So 10-year swap is very easy and a plain vanilla transaction, but certainly destroys value at today PPA prices. If we do a net floor, 10-year at capture prices of 23.7 or close to 24, which already includes a premium of around 3 or 3.3, you see that obviously your profitability expectations increases. Okay, so because you were able to capture obviously all the upside. So if you as a sponsor or as a lender think that the price is going to be above 40, 45, 50, then you're still on a very good case. There is no rule for which one to use, right? It will depend on your vision again on the long term. That's why it's so important to count with people like Aliasoft and others, just to have long term, very, very well informed decisions about how long term pool projections will be, right? This is a structure that we're implementing a lot, which is a mix of 3-year swap and a net floor for the following 7 years, where you have the benefits of both worlds, right? You still have the certainty of a 3-year swap, so you are safe and close to the market levels, where you still get the upside on the latest years of the PPA structure, right? You will probably have all this at your disposal if you request the presentation, right? So again, volatility is there. Important to have a long-term view, and the main conclusion is that obviously renewable projects are still profitable, okay, and viable without any subsidies, okay. No longer at two-digit numbers, okay. The use of debt, as always, without a PPA, improves shareholders' profitability by lowering its WACC. However, if you have a large project, okay, it's strongly recommended that you enter into a PPA, okay. Current PPA price levels and absurd terms destroy value for shareholders, okay, and for the project as a whole. So it is very important to be very aware of the evolution of the electricity futures market, tenor and liquidity, the implementation of energy-based auctions that will bring stability. So the energy-based auctions are another kind of PPA, right, with the system, with the administration. And a greater appetite and understanding of the merchant risk, but risk capital providers, whether those are investors or lenders, okay? So all this will be key in the development of renewables. So hope you enjoy the presentation. I'm happy to take questions after the presentation of Pablo. Pablo, all yours.
Yeah, thank you so much, Carlos. Thank you so much, Oriol, for the presentation that were before presented. Thank you, Aliasoft, for this opportunity. It's a real pleasure to share together our thoughts and how we see the market. Okay, so let me just present the second part. I think that I don't know if you see the presentation already.
Yes, we see
it. I will switch off the camera just to put you focus on the important things. Okay, so I'm just the simple accountant, so do not expect that I will teach anything about the energy market, business, and so on. I'm just the guy helping the companies just putting the numbers into the financial statement, or I'm part of audit teams just to ensure that all the estimates are reasonable and are compliant with the standard rules. So, but we will share how we see the market today, and I will go pretty fast on the general topics, and I will more focus on the price hedge, on the hedging price of electricity in terms of accounting. Okay, so. As a summary, what we see is that we have a mix of local players to international group playing in different language, but with the same rules. And at the same time, we have some spectators that are very critical, which are the investors, the banks, and regulators. I think that Carlos has mentioned, just taking the case of Spain, what we have is a lot of money that will come up as investment just to achieve all the renewable objectives that has been in place. So I think that all the issues that we are facing today is going to be just the top of the iceberg. So what do they expect? Basically, they expect to see or to use some information that provides some view on the risk exposure, the investment performance, the business performance, and also quite important, the comparability between some of the investments or projects to undertake credit risk, for example, for the bank. So at the end of the day, we are not important, but financial information is quite critical because it's the one that is used for everybody. So I think that the reliability is more than worthy in this case. So really the presentation of energy price hedge on financial statement, it's easy to look at. I think that just previous coming from the last year, you think that you have so many different type of PPAs with different strategies, as Carlos mentioned, and we are on a little bit nightmare of the accounting classification because we have so many diverse accounting treatment. So I think that is not that easy. It's so easy to see at the financial statement all of the risk management that the companies are taking to. Okay, so just back to the question where we can find some of the figures or some of the results on the performance. So at the end of the day, when we see some physical hedges, so physical PPA or not virtual PPA, what we will have is, if I'm a producer, we have some impact in the revenues, and I will have some trade receivables. And if I'm an off-taker, we will have some operational expenses that are for sure reflected in trade payables in the balance sheet. More complex questions arise when I have some impairment loss or reversals due to some price hedges that are embedded in certain class of assets. It is really related with the last part of the Carlos presentation, when if we are destroying value to some investment or we are producing value, it will appear more probably in the impairment test of some of the assets. And finally, we will have this fair value variation gain and loss coming from derivatives or cash flow hedge reserve that we have in the balance sheet. All of them we should check on the notes of revenues and cost and the disclosures, or in some of the notes of the non-current assets and financial instruments, equity and risk exposure. But at the end of the day, what we have seen is that there's so many type of hedges, so many different accounting treatments. So the devil is in the details, but if there are really any details on the financial statement, that's a problem. So with this mix of complexity, what is, I think, the current problem that we are facing? It is really comparable between peers. I think that the management teams are struggling with all different strategies that are available. They need to design if I go to merchant, or if I go and just I cover some part of my production, or I cover some part of my cost, but also I need to deal with the diversity of hedge contracts, which are not, as you may know, not so easy, because are pretty unique or pretty customized for every transaction. And at the end of the day, also we have a really diverse accounting treatment and disclosure that need to put on the financial statement. So the stakeholder really see the risk appetite and the performance of the risk management that is in place for different companies that they are comparing. They can have a sensitivity in the access that the companies has to PPA or to hedges, its negotiation capacity and then the execution skills that the top management has on this specific market, and how are explain the results volatility and how they communicate the short and long-term implication of this uncertainty that we have seen in the previous presentation. I think that for the top management, it's not easy to manage for sure, but therefore it's there. And the stakeholder is really clear, not easy to look at because apparently we have similar exposure, similar hedges, but when we go to the financial statement, it's not so easy to compare. So, but the understanding is needed because the decision needs to be made. So I think that this is really still close. To close the distance, we have still a really long path to recover. So go to the more detailed issues. We are today facing in accounting advisor or in auditing, we are facing so big challenge in the accounting. Okay, so among others, where we find the most critical accounting estimate. I think that you may know the impairment test of some assets, non-current assets, what happened in a business combination when I merge with another company that is a producer or is a manufacturer, which has a really high exposure to energy price in the P&L, which are the estimate that I need to provide a fair value on the balance sheet for the derivatives, and which are the implications for hedge accounting. Which are the common issue. I think that's most of them has a cash flow operation. We will speak a little bit of that, about how can you forecast the future energy price that affect to my investment or to my current assets. But also when I buy a company or I enter into a new joint venture, I think that all the assets and liability that were already in place, I need to estimate a fair value. So I need to make the price allocation. In terms of derivatives, also we have a cash flow operation, but we need to consider some of the components of the valuation, which is the premium and margins that are embedded in those transactions. And also there's a lot of option embedded, like floors, as Carlos has mentioned, that are coming up and makes much more difficult the estimates to provide. And finally, the hedge accounting, we have also cash flow operation, but in this case, we will put another variable, which is the hedge item evaluation, which is not so easy due to the different profile of production or consumption for the counterparty. Which are the ineffectiveness source, how can I explain it, how can impact on the P&L, and how can I make the reclassification from this cash flow reserve that I have in equity to the P&L just to offset my hedge exposure. So what we see is, are you using the same inputs for all this type of cash flow projection or estimate for the fair value? I think that the majority of the company has really a quite clear overview, and might they have similar inputs, but there's a lot of components on the valuation and estimation that might be different. So when we do, for example, a due diligence, or when we do another audit procedures, one of the key issues is if I not have contrary evidence of one estimation for the impairment test and one estimation for the derivatives, for example, or which are the implications for hedge accounting, because the P&L might not be reflecting all the ineffectiveness that I have in the hedge. And quite good question and quite debating question is, do we really understand the meaning of fair value? I mean, we see so many teams that are pretty good on estimates and cash flow projection, but sometimes are really focused on modeling and really focus on the cash flow projection reliability. But we need to think that the fair value is just an entry price or exit price. I mean, we can see, as Oriol has shown or Carlos has shown, really a projection on a mid-market and some of the tendencies for the long-term forecast projection in terms of price. But at the end of the day, what is really matter is, can I access to a PPA of 30 euros? Can I access that to a PPA of 60 euros? Maybe, despite the fact that the modeling show me that it's possible, this type of levels, at the end of the day, you have a market. So you have a buy and sell cross that is need to be considered. So I think that in some of the cases, we are not really focused on the fair value, which and its components. And finally, are we consistent in the procedures years on year? I mean, are we keeping the same methodology and inputs for the different years? Because if I change, because it's much more interesting or because it's much reliable, the new inputs that I use or the new methodology I use, I need to think that my financial statement just try to capture what has been passed from the beginning. So maybe I have so many impacts due to this update on methodology. So I think it's I used to say that the accountant need to go behind the economics or behind the business, and I think that in the business they are more focused on the reality, and we need to put the accountants a little bit more common sense in the valuation models. Finally, I really want to close with this complex issue, which is the hedge accounting. I think that everybody has to show in the financial statement that I have a hedge and I have not volatility in the P&L, but to just to achieve this objective, I need to apply some requirements and some complex rule that finally what they are trying is to see the offsetting capacity of the hedge. So we can have some estimates for the impairment test, some estimates to get the fair value of the derivatives, but the hedge accounting is just a comparison issue. I mean, I need to compare two things, and here's the real problem. If I have an entity which I can say I can be a solar farm or wind farm, I will have different profile in terms of production. I mean, I have the same exposure to energy price, but due to my production profile or to my consumption profile, this will be really different depending on the place that I am. Okay. Additionally, we have different hedging instruments. For example, we have 10-15 years base load at 45. This contract will really have same effect on the solar farm exposure and in the wind farm exposure, or in the supermarket chain exposure, or in an automotive manufacturer exposure. I think that we all agree that nothing is comparable. They have the entities have different profiles, and the hedging instrument that I enter into, it's pretty different, or I can get an offsetting result quite different. So when I have to make the hedge accounting procedures, especially when I have to decide which part of the volatility I can keep on OCI or on inequity for future periods, the key question is, are the same cash flows, the hedge exposure that I have and the hedging instrument that I have. How do they evolve? I mean, because at the beginning, I can see that we have a different cash flow forecast, for example, but also they will evolve differently. I mean, they have the same price sensitivity. We have seen that the capture of the photovoltaic producer is much more aligned right now to the market, but in a yearly average. If we take into account the seasonality, we have different results in different moments of the year. So imagine which will be the case in different moments of the plan. I mean, the first 2 years after the construction, the 10 years after the construction, and so on. So it is something that is quite dynamic. So I think that I need to take into account that if I have different price sensitivity in the exposure and in the hedging instrument, I think that the result will be different. Also, there's a strong demand sensitivity diverse, because, for example, an automotive manufacturer can stop the consumption, but a solar farm will not stop the production. So I think that there is a lot of diverse sensitivity in the hedge and the hedging instrument that need to be clear answer in the hedging accounting requirements. I think that there are so many things. I think that we have not much time, and I prefer just to go to the Q&A session. But let me just finish with the couple of questions. That how did they present the valuation, the variation, the balance sheet and P&L? It's a question of comparison again. I don't think that just because I have same tenor, for example, I have 10 years PPA and I have a exposure of 10 years production or consumption, it's gonna be just equal the offsetting of the fair value variation of the derivative compared to my exposure. I don't think so. So in this case, we have a really strong debate regarding should I use the yearly average forward Q or should I use the hourly forward Q? I think that this is important, not, for example, in an impairment test or when we are analyzing how to finance a new project, but it's really important when I need to compare two magnitudes. If I need to compare the hedge item and the hedging instrument, I think that I need some sensitivity or some granularity just to present the different result if I have a base load derivative or if I have a hourly profile derivative. So I think if economically those two instruments, the base load or the hourly profile derivative, are not equal in terms of economics, how do they appear to be similar in the accounting of or in the financial statement? And why should I care? I think that if somebody is trying to see which are your performance in risk management, I think that you need to provide some information and you need to show which are the pros and cons on being a hedge for the 50% of my production or my consumption, hedge with a base load instead of hourly profile, and so on. So I think that we all agree that it is so difficult to achieve the perfect hedge. So I think that illustrated this imperfection on this different offsetting capacity is an issue that is not, I think, well dealt sometimes on the current market in the country. And I think that I finish here. So thank you so much.
Thank you very much, Carlos and Pablo, for that great presentation. And thank you again for sharing this webinar with us. Hopefully next year we can have a new webinar and it will be in a less uncertain time. Unfortunately, we have run out of time, so we have answered some of the questions already by writing, and we will answer the remaining questions directly by email. Once again, thank you, Uriol, Carlos, and Pablo for your presentations, and the audience for joining. Have a nice day.
Thank you so much.
Thank you. Goodbye.
Bye.